Because we do like to start on time, we will get underway here. So, good afternoon, everyone. Welcome. I'm Casey Snyder, and per usual, I'm joined today by Tom Sidoric. And with Tom's transition to his senior advisor role, or chair emeritus, as we will often refer to it, Erica Sullivan is also on screen as she has become increasingly involved in all aspects of our practice over the past few years, and she may or may not chime in today depending on how we do. So, on behalf of everyone here at Clove Hitch, we want to thank you for taking the time out of your busy summers to join us for our 2025 mid-year semi-annual market update. And our efforts here this afternoon are an attempt to try to provide some sense of clarity amidst a world full of noise. So, first, and consistent with prior webinars, we'll reflect on the last 6 months and oh, what a last 6 months it has been. Then we'll provide what we feel is important historical context around today's markets because of how it may impact you and your plan. And then finally, we'll discuss some key themes for the future as we look ahead and help you plan for your future. So now, assuming compliance approval, a recording of this conversation along with the full slide deck will be emailed to all attendees and to those who couldn't join live for replay at your convenience. And while today's discussion is tailored for our clients, if there's a close friend or a loved one you feel may benefit from hearing this, we welcome you to share the replay or even future invitations. And we also want to briefly note we've historically maintained a self-imposed limit of 6 to 8 new client relationships per year to preserve the depth and quality of our service. And with a new team member joining us this September, Erica will share more about this here at the end. We anticipate responsibly expanding that capacity to 7 to 10 relationships annually, which is still very measured and still intentional. So lastly, before we jump in, just a quick reminder, we'll conclude with a Q&A session as we always do. And for confidentiality, we ask that you use first names only when asking questions. So with that, again, thank you for joining us this afternoon, and we will get started. So first, Tom, we are going to look back, and we begin today with the elephant in the room, and that being policy uncertainty. And when you look at policy uncertainty as measured by the Bloomberg U.S. Economic Policy Uncertainty Index, you can see that within the first 6 months of the year, it has been nothing short of historic. There's a lack of clarity over U.S. trade policy, with tariff rates at levels not seen since the 30s. Okay, many rates are still unclear. There's geopolitical tensions. We had a negative quarter of GDP. Many companies have even stopped issuing forward guidance, and many companies are even on pause until they have more clarity on how to proceed. And yet, despite all of that and more, we haven't witnessed a market meltdown like we did at the onset of the pandemic here, nor the global financial crisis here. So in some ways, markets seem to have largely shrugged off the chaos in some ways. And Tom, chaos is a term that I think you want to expand upon a little bit here.
Yeah, it's when you talk about history, you always go to me because I've got a little bit of it. But I have to say that in my experience, I've never seen anything quite like this. I've got a cover of The Economist magazine. This is 2 weeks ago, and the headline, you can't see it on screen, but the headline is New, Untested, and Dangerous, a special report on American finance. That's not us writing it. That's The Economist magazine, as you probably know. And then the header inside was New and Untested. American finance is exceptional under Donald Trump, but is also exceptionally dangerous. We don't know how this is going to play out, but we know it has played out somewhat in certainly in the media, but has yet to really play out in the markets. And we're waiting and see. We take a wait and see attitude about how it's going to unfold.
Yeah, and just because markets haven't come unglued doesn't mean that we haven't had to navigate some historical volatility. And that's what this chart here reflects is Now, how much volatility stock market investors have endured by decades. So, give you a quick summary here. Total number of 1% up and 1% down days in the S&P 500 by decade. So you can see here the 1960s, there were 227 days, the 1950s, 315, and so on. We're only 5 years into the decade, and so far, we're on pace for a historical 10-year stretch. Okay, so between COVID, the dramatic rise of interest rates in 2022, and now this administration's economic policy, as I just mentioned, we're on pace for a record setting decade to eclipse that of the 2000s. In the 2000s, which was bookended by the tech bubble and the great financial crisis. So, in some ways, what we're saying here is look, if markets have had you on edge at some point over the last 5 years, you've had every right to be because it has been volatile.
I'm always reminded of something though. The longer we walk a tightrope, the better our balance gets.
So now, however, we say that, right? However, volatility is in fact the price of admission when it comes to the stock market. And as you can see here, volatility, whether it be historic or not, is quite normal. So what this graphic reveals is the dark blue reflects the annual rate of return of the S&P in any given year. And what you can see by way of the gray diamond, that's the intra-year drawdown during that year. So if you look over to 2025, you can see in April, the intra-year drawdown, we were down 19% on the S&P 500. And who would have thought that we would be back up in positive territory so quickly at the time? If you go back to COVID, there was a 34% drawdown in March and April of 2020, only to close out the year up 16%. And if we look at another extreme event, if you look at the great financial crisis, you can see down around 49%, closed out the year down 38, followed in 2009 by another 28% downturn. And who would have thought again that you would close out 2009 up 23? So the uncertainty or volatility, or some may say risk, is what you have to endure to achieve meaningful returns. It's normal.
It's normal. It's the price of admission and probably exacerbated by the news feed that we're all subjected to these days.
And, and volatility tends to take on a negative connotation, but there is volatility that we do enjoy, and that is when volatility works in the upward direction. And that brings us to how different asset classes have performed so far this year. And so through the first half of the year, and again, this is the kind of volatility that people tend to enjoy, you can see here that international equities, as well as emerging market stocks, have dominated returns after having lagged the US for the better part of the past decade. And again, you can see commodities, US large cap stocks, this is a few days dated, so things have fluctuated some since. But this provides an important reminder regarding the importance of diversification. It's something that we've been harping on over the past few years as valuations in the US have reached extreme levels. And maybe a fun fact for some, but we had a recent conversation with Capital Group's portfolio management team, and they were discussing how the average US investor was grossly underweight international and emerging market stocks coming into 2025. And I say this is sort of a fun fact because we've maintained our global exposure. And for many of you, we've been increasing some of that foreign exposure depending on your risk profile, savings, and goals. So this is that reminder at the midway point how important it is to remain diversified.
Thank God.
Well, and so what are some of the reasons behind this strong performance overseas? So part of the reason, and if we just look at European equity resurgence, is because of how European governments have taken bold steps to strengthen their collective security and economic capacity in response to the potential global realignment. But Europe is not solely reliant on old economy industries. And so, what this graphic reveals is how the recent Global Innovation Index And it shows that 7 of the top 10 countries for innovation are in fact European. And not only that, but a number of industries are represented here, which is very different when compared to the US, which is predominantly big tech. So this is a surprise to many. A lot of people think of Europe as being stale, and this shows quite the opposite.
And a reminder about why we always talk about don't invest in the rearview mirror, don't focus on what was great in the 1960s, and don't invest with blinders on. The world's a big place. You need to be exposed to it in your portfolio.
So another significant reason for the strong performance of foreign equities is in 2025, we have seen the weakening of the dollar, and the dollar just wrapped up its worst start to a year in decades. And a weakening dollar acts as a tailwind for US investors holding overseas investments, and it tends to benefit US exporters. So the last time we saw the dollar weaken so significantly at the start of the year was actually 1973, following the United States shift that ended the dollar's link to the price of gold. So you can see here, this is a pretty dramatic decline, and it has been fueling those strong returns in many of your foreign strategies.
And unless we go back to pegging ourselves against gold, this could possibly continue.
Yeah, that's a good segue here, Tom, because that, in yes, the dollar has weakened and it's off to a really rough start, but the dollar was starting at such a high point that the dollar still isn't weak. And for those unaware, when we think about dollar cycles, they're cyclical, similar to markets. And so there's periods of strength followed by periods of weakness. And on average, these cycles, whether strength or weakness, tend to last about 8 to 12 years. And coming into 2025, the dollar was in year 14 of an abnormally strong cycle and was viewed by many as eventually this is going to roll over and turn. And what you can see here in this chart is that the gray time period represents periods of a declining dollar. And it's during periods of a declining dollar when foreign assets, foreign equities tend to outperform. So what you can see is since 2008, okay, there was a period of a strengthening dollar, and therein lies where foreign assets underperform their US counterparts. Okay, so if we are in the early stages, you can see this little gray bar is back. If we're in the early stages of a weakening dollar cycle, that would tend to bode very well for foreign equities. And this just shows it's really hard for foreign equities to outperform if, in fact, that dollar remains as strong as it's been. Um, and no look back would be complete if we didn't touch on fixed income real quick. So as we look back on the first 6 months of the year, we look at the different categories within the bond market, and we can see here that bond markets and income strategies are doing what they're meant to do. They're generating meaningful income streams. They've behaved like the diversifier they're meant to be. So if anybody were to have looked into their statements or looked at their statements in April and May, they would have seen how well the fixed income markets held up. And really, they're on pace for what we would deem an average year, which is a very welcome sight given some of the years the fixed income markets have had of recent. So this is all good news from our perspective. Anything to add to that, Tom, or ready to move in the
Well, I
next?
just think about how blessed we are that returns in the bond market have normalized because of that period of subpar, 1%, near zero interest rates that we had to endure for 6 or 7 years, with many of our clients, in retirement, needing income from their investments. And the fact that in many cases they had to expose themselves more to the equity markets than they really wanted to. So bonds doing their part again is so welcome, I can't tell you.
Yeah. All right. So now we're going to shift gears and we're going to look to provide what we believe is important context. And the idea here is to step back from the day-to-day noise and acknowledge that no one knows what the catalyst may be for shifts within marketplaces or when they top. Okay, but rather we want to respect how change is constant, and sometimes it's easier to understand change or appreciate it through a historical lens or when you take a step back. So we're going to start with a chart that all of you have seen many times, but the message remains important. And yes, it's this slide again. All right. But as a quick reminder to those, this reflects a regression to trend of the S&P over time. So the black line across the middle is considered the trend line, and the light blue shaded area represents when the S&P has been above trend, below trend, above, below, etc. Okay, and what you can see is that for the last couple of years, we've been living in this highly unusual, call it valuation range. And if in fact markets are to mean revert as they have historically, you can get a sense of the magnitude of what that would mean. Okay, so when I say mean revert, I'm referring to if valuations or prices were to decline and then break through their trend line down here. So historically, mean reversion has happened one of two ways. First, it's been sudden and dramatic, Great Depression style, or something like the tech bubble, where it falls significantly. The alternative to this is more of an escalator like incremental annual returns sort of moderate over time. Okay. Or maybe it doesn't mean revert. But all of history suggests that this will happen at some point. It's a question of sequencing, how and when. What we do know, though, is when you see a four standard deviation distortion and valuations this far away from its mean, it's something that needs to be respected.
And a big part of our job is to manage expectations, not just assets. So part of the reason we keep bringing this chart up is as a cautious reminder that equity valuations are very, very, very extended.
So, continuing with this theme on valuations, and this is important because we talk about valuations quite a bit. Valuations mean very little in the short term. So you can see the header here. Valuations are a poor predictor in the short term. This scatter plot reflects annual rates of return in any given year based on valuations below. So when you see 20 times earnings down here, 22 times earnings or above, these are considered expensive valuation ranges. But as you can see, there's no discernible pattern based on whether a market is expensive or whether it's cheap. We've had great years, we've had horrible years. Okay, that's on a year to year basis. However, when we look at this over the long term, and what we have here are 10-year forward annualized returns, okay, suddenly you can see that when you're in that expensive valuation range, valuations do very much tend to matter as it relates to longer term returns. So when you see valuations in this range, historically, they've been associated with well below average 10-year annualized returns. But this speaks nothing to the path by which they've occurred, the sequencing of it. It just means, to Tom's point, we need to really recalibrate expectations, proceed with caution, and understand that things can happen beyond what we can sort of understand in the moment.
And Casey, you've also brought in a very important chart a little later in the presentation about capital market assumptions and some of the big guns and what they're thinking. So we'll talk about that further.
Okay. And then we dusted this next page off just as the reminder. So we actually had this within our mid-year webinar last year. We're recycling it because of how it provides that reminder that when markets have reached extreme valuations in the past, investors have at times had to endure really challenging markets. And so you can see here there are different time periods listed where it shows the real annualized return of the S&P 500. You can see from 1928 to 1941, it was pretty anemic. You've got 66 to 81, a negative 1% annualized real rate of return, and then most recently the 2000s. So this is just that reminder that markets can turn when they do mean revert. It can lead to a very challenging stretch. And I like to think of it in the sense that every generation has had to endure a really difficult economic period, and at a time when they've already accumulated wealth. So there aren't many on today's call that had accumulated wealth from 66 to 81. So we can talk about it. It's easy for us to talk about these environments while markets remain rich, unemployment remains low, and the economy is strong. But these market downturns or challenging times don't occur in a vacuum, and they tend to be associated with general economic angst, unease, job losses, forced housing transition. So the impact of these eras or decades are important to respect within our planning process, understanding that they could happen. All right. Now, continuing with the theme of valuations, we're going to move away from the US and we're going to move into those foreign markets here for a minute. This is also a chart that we dusted off. We actually intentionally left it out of our February conversation because we felt like we were repeating ourselves, but we brought it back in for good reason because foreign equities have now delivered. And what you can see here, you can see by the title, price to earnings discount versus the US. All you need to understand in this chart is the lower this gray line goes, the cheaper international markets are relative to the US. And you can see coming into 2025, we were looking at one of the steepest discounts in decades. And even after a really strong 6 month stretch, you can see how inexpensive they remain relative to the US. So while we're talking about domestic markets in some respects being historically rich, some of those foreign markets still look historically cheap.
And this is where we talk about, think about the things in your garage, the things in your medicine cabinet, where they're made. They're often made not in the United States. And this is why we still continue to beat the drum for our foreign holdings.
So this is, uh, from a 30,000 foot perspective, this is encouraging. Again, we're going to move into the world of fixed income. And this graphic provides some important context about what we just lived through with the bond markets. All right, it's a busy page, so I want to break this down as best possible. What you can see here, all right, are 5 year annualized returns color coded by decade. Okay. And so the takeaway from this is look, the higher the starting yields, typically the higher the 5 year annualized return. It's kind of that simple. And over time, you can see the 80s, the higher the starting year yield, the higher the 5 year annualized return. So the 80s are in dark blue. You move into the 90s in light blue. You can still see starting yields were pretty high, interest rates were falling, and you can see what those subsequent annualized returns were. They're very attractive. You move into the 2000s, interest rates had continued to come down into what we would deem a more normal range. And then here came the 2010s, following the great financial crisis. Those starting yields are low, therefore, those annualized returns are low. And oh boy, look at the 2020s where starting yields hit rock bottom. Okay. But what you can see now is look at where starting yields are today relative to the last 15 to 20 years. All right. So the outlook has improved dramatically. And in many respects, we just lived through what you could say was a lost decade in bonds. So we just a few minutes ago talked about how equity markets can deliver some really challenging stretches. We just lived through one in the bond market. And the beauty of this, though, is that when we look ahead, despite US equities being rich in valuation, and to Tom's point a few minutes ago, bonds are back to delivering really attractive yields that are in support of retirees needing income, and the conservative sleeve of a portfolio is no longer the laggard that it once was. All right, we're going to move away from stock markets and bond markets, and we included this graphic because we've received a number of questions recently about the frequency of recessions, and because of how long it's been since we've experienced a real recession. So this here shows the dark blue shaded time periods reflect recessions in the US. And what we can see are that recessions are far less frequent following the Great Depression. And we haven't had a real recession in almost 16 years. We don't really count the COVID recession because of how it was somewhat self-induced. Okay. But again, we're including this because when time passes us by, it's been 16 years since a real recession. It's common for sort of complacency to set in. Investors with, call it fresh wealth or net worth or balances that they've never had before or have never endured a real recession, even those with the most disciplined or clad iron stomachs can get a little nauseous during a real downturn. So we brought this back just to kind of remind everybody that, look, recessions happen. We don't know when the next one will be, but there will be one. And in many respects, recessions aren't necessarily a bad thing because of how they flush out bad capital and make room for new.
It's also worth noting, and I've noticed it, didn't mention it to you, Casey, but I know you're aware of the fact that the Federal Reserve didn't exist prior to 1913. So if you look at some of these darker bands and the depth of those recessions prior to, and particularly after the Civil War, they were serious and deep. And then the Fed came around 1913. They finally got their feet underneath them. And you notice that the recessions since the Fed's establishment in 1913 have been much less and much shorter.
Yeah. We always say there's another recession out there. We just don't know when it's going to occur or how deep it will be. So, and this is our last page here within the important context section. And this is an important one. And it's something that we are speaking about on a regular basis. And on the left-hand side of the page here, we highlight the structural deficits that the US faces right now. And then on the right-hand side of the page, it's some context about how advantageous our current tax environment today is relative to history. Understanding that nobody likes paying taxes, but still, if you had to pick an era, today's not a bad era. But let's begin quickly on the left-hand side of the page. And what you can see here is total government spending color-coded. And the line item that really stands out is right here. It's net interest expense. And I remember tracking this chart over 10 years ago when this category was less than 3% of the overall annual budget. It is now ballooned up to 14. And there's an interesting takeaway from this too. There's been a lot of research and study on that when a country begins to spend more on their net interest than they do on defense, it is often represented sort of a tipping point as it relates to their ability to responsibly manage their debt. So over here, you can see those structural deficits where the US is borrowing about 20% of its annual budget. A new line item here, tariffs, representing about 1%. If recent projections, I think they were announced the other day of around 300 billion are true, you're talking about tariffs adding about 3.5% in terms of revenue or sources of financing. But still, we have a sizable structural deficit. And trying to sort of simplify what is otherwise a very complex equation, right now, the economic agenda is an attempt to grow our way out of this structural deficit. Okay, it's through whether it be deregulation, crypto, AI, business, etc. It's to increase tax revenue to get out in front of this. And that's great if it works. The challenge is if it doesn't work and we fall short, then we do face the risk of being in what would be deemed a debt spiral, where you're having to borrow more, and the more you borrow leads to an increase in your net interest expense, and it's this feedback loop. And sometimes that can lead to measures of austerity, usually a combination of rising taxes and cutting spending, similar to what Europe endured in the 2010s following the European debt crisis. So this stands paying very close attention to. It is an issue, it is a challenge, it is a concern. It's something that we're watching. It's also something that the bond markets are paying very close attention to.
And if you're looking for some light reading, Ray Dalio has written a book about this. So have at it.
I actually just ordered that, Tom.
Yeah.
Now, we figured it was worth pairing the structural deficit concern with a little historical context on tax rates. Because again, as I just mentioned, we know that nobody enjoys paying taxes, but depending on how the structural deficit plays out, we're looking at the effective federal tax rate being abnormally low relative to history. And we're looking at capital gains and dividend tax rates being what we would consider advantageous currently. But at some point, this may become a problem and the bills may need to be paid to a certain extent. All right, that brings us to our themes for the future. And Tom, we're going to start with something that you've already referenced, those capital market assumptions. And this is something that we have included in a handful of webinars now. These are forward-looking capital market assumptions published by Vanguard. And it's their forecast. So it's as if we're 10 years from now looking back. And this is what they believe returns may look like within different categories of the global marketplace. And so the kind of the turquoise colors here represent different categories of the equity markets. And what you can see up top is that they're forecasting a 3.8 to 5.8% return within US equities as a whole. And the takeaway from this is what they're forecasting is well below historical average. If you look overseas, you can see that forecast is a bit more optimistic and more in alignment with historical averages, something we sort of referenced here a few pages ago because of valuations. You can see here in the US value, typically more of your dividend payers have a pretty optimistic outlook based on valuations and other variables. And US small companies also, which have been relatively cheap compared to their larger counterparts. But in general, we're looking, especially in the US, at below average returns over the coming decade. If you drop down below, you can see the forecast within different categories of the fixed income market. So these are all different bond categories. And the general takeaway from this is you're looking at 4+% returns across the board. Again, starting yields are higher, therefore it typically translates into higher annualized returns. And we've also had a few people pick up on this, where when you look at equities versus fixed income, the returns don't look too dissimilar from one another. But the difference being is that fixed income or bond strategies tend to have much lower volatility rates. And so all of a sudden, and this is why we've titled this page, future returns may look very different than the past. And it's often really difficult for us to comprehend how that can happen, but it has in fact happened plenty of times before.
And this shows you how tired domestic growth in particular is. And I think it's highly unlikely that we'll ever generate returns like it has in the last 10 years going forward.
So we decided to incorporate this page because of how important it is to understand that market structure does evolve. Industries evolve, consumer demand fluctuates, things change. And great companies don't always equate to great investments. So what this here shows are the top 10 companies by market cap by decade. So you can see the 1980, 1990, 2000, etc. Below that, each name has a box next to it. And those that have a gray box reflect how the individual company outperformed the broader market over the coming 10 years from that time point. The light gray box represents how the company underperformed the broader market over the following 10 years. And so what you can see here on this page is that the majority of top 10 names actually underperformed the broader market in the 10 years to follow. And so the question is, if history repeats itself to some extent, and we look at where we are today, the majority of these top 10 names will underperform the broader market. And it is so hard for all of us to comprehend how that can happen, given the success that they've had and the innovation that they're behind and all that's to come. But this is what we mean by market structure changes.
And not investing in the rearview mirror.
Exactly. Now, we've mentioned dividend payers, again, themes for the future, and this has been a common theme. This has come up a number of times in the last few years. And we turn our attention here to dividend payers because they're back in the spotlight. And they had been overshadowed by growth in tech at times over the last 5 or 6 years. But they are showing their true value, especially this year. So what you can see here is that dividend payers have historically provided a measure of stability during market declines, but have also provided positive returns when markets have advanced. Okay, so you can see dividend growers, dividend payers, the global universe. You look at annual volatility down below and annualized return. And just for clarity, dividend growers versus dividend payers. Dividend growers are companies that have a long history of increasing their dividend payout. And these tend to be very good inflation fighters because they do have a long history of keeping pace with and outperforming inflation. And for compliance reasons, I can't specify the exact position, but I can tell you that many of you own a strategy that is solely focused on owning dividend growers. It's a position many of you have had for many years, and it's for exactly this reason, whether it be compounding dividends during your accumulation years or now beginning to live off of those dividends in your retirement years. And then over on the right-hand side of the page, what you can see is that, yes, there are certainly dividend payers here in the US, but a lot of these 3+% dividend payers are domiciled overseas. A little bit more detail on this, and what you can see by way of index. Okay, we said looking for dividends, you may want a passport. Down below, you can see that these are different indexes. So this is the MSCI All Country World Index, X the US, the Emerging Market Index, top 1,000 value companies in the US, the S&P, growth companies here in the US, and then small caps, so the Russell 2000. And what you can see here is that, for example, the Russell 2000, there aren't a lot of dividend payers in there. And even those that do pay tend to be in that 0 to 3% range. So if you look across the page, you can see that the majority of higher dividend paying companies are within those foreign markets. Okay? And even the S&P, it looks like, wow, almost 70% of it's in that 0 to 3% range. Well, if you look at the S&P today, current yield is only about 1.2. So overseas markets tend to be at least double, almost triple that. So I guess the tagline here would be, in some respects, it pays to be overseas. All right, now we're talking fixed income again, except fixed income is no longer dollar boring. We've now brought it up a few times, and we've done this intentionally because of how important it is. We know it doesn't make headlines all the times, but these are attractive returns. And we're looking at some of the most compelling yields in years. And so you can see here, we have our different areas of the bond market down below: US Treasuries, municipals, investment grade corporates, etc. And what you can see is that the pink bar represents the last 15 years in the median yield, the median income stream. And the gray area represents the 15-year range. So at one point, to use US Treasuries as an example, US Treasuries were only paying 0.5%. And the 15-year median was only 1.6. But the blue diamond represents where they are today, give or take. And the message here, and what you can see as we plan for the future, is that yields across the board are materially higher and attractive to what Tom had mentioned earlier, and thank goodness they are. And one in particular here on this page stands out, and it's this, the municipal bond space. So this is showing your taxable equivalent. So as if it were taxed at the highest bracket, what the equivalent yield would be. We are looking at municipal bond yields now in the taxable equivalent in the 6 to almost 10% range in some categories. So if you're in a 32, 35, 37% bracket, these are the most appealing yields we've seen in well over 15 years. And now, because of how attractive they are, even for some in the 24% bracket, we're looking at opportunities here. So this is very appealing. Again, you pair this with really expensive US valuations, where according to Vanguard, you want to plan as if you're going to achieve lower returns. These really jump out at us.
And to say nothing of the fact that, it's quite possible the tax rates in the future will rise. So the tax-free income stream from municipals may be doubly appealing a couple years from now.
Yeah. It's, all right. So this brings us to our last page here within key themes for the future. And no conversation about the future would be complete if we didn't bring up the concept of AI. It's everywhere. Love it, hate it, fear it, some combination of all of that. It does look like AI is going to be the fourth industrial revolution, and it may have even deflected a recession in 2023. And to think, only 9% of firms have adopted AI to some extent. So over here on the left, what you can see, it's broken out by sector. It shows the percentage of each sector that were using AI in September of 2023, 2025, and then projections for the next 6 months. And in aggregate, in total, we're looking at only 9% of firms using AI at this point. And when we think about the power of AI and how the AI we see and use today is the least intelligent AI we'll ever see in our lifetime, it's staggering to think about what's to come. And the economic value of this is so hard to forecast and quantify. And so that's why we wanted to pair this with some examples from the past. So in the past, innovation or tech was more user based. And so we'll use mobile phones as the example. You quantify the number of users, the number of those who are going to be using phones, the turnover rate, and extrapolate those numbers, and you could get a sense of its economic impact or valuation. But with AI, it's really challenging to predict the breadth of adoption. Now, what we can take away, though, from prior innovative periods is that rarely is adoption linear. Okay, profitability and gains in productivity are irregular, they're winding, and historically there's been a period of what we would call overexcitement, the run up, the build up upon the launch of innovation. Think about the internet with the tech bubble in the late 90s. And then there tends to be somewhat of a letdown or a drawdown. But in general, and you can see here down below, we have a long history of grossly underestimating the economic impact of the innovation itself. So, what we do know is that the world is going to look very different 10 years from now. What we don't know is how AI is going to improve productivity and profitability and at the pace by which it will be incorporated in.
And I can say, as one of the older guys on this call, that many of us might fear AI. We've been incorporating it into our practice for a number of years now. Certain elements, things like Riskalyze and GPM, goal planning and monitoring, that we use to help you make sure your plan's on track. It's not, you can use, it's a powerful tool that's here for good if you use it wisely. And I think anybody that's been afraid of it or doesn't know what it is, just give it a shot. If you want a little quick tutorial, give me a call. I'll tell you how I learned.
Well said, Tom. Yeah, and I think we talked about in our last webinar how we are beginning to incorporate, or not beginning, how we are incorporating it into our process, and we'll continue to do so. So that brings us here to a quick summary before we wrap up and open it up for Q&A, as well as a quick team update by Erica. Want to just quickly summarize. Looking back, okay, uncertainty remains high. That's likely to continue, but returns are broadening, with foreign equities leading the charge for a variety of reasons, and volatility is that price of admission. Important context, look, valuations matter over the long term, and areas of the US marketplace remain historically expensive, but overseas markets still look relatively cheap, especially if we're in the early innings of a dollar weakening cycle. And bond yields, as we said multiple times today, are as attractive as they've been in the last 2 decades. And lastly, everyone should enjoy the current tax environment for as long as it may last. Now, key themes here for the future: the only constant is change, whether that be in markets, the economy, or our lives. We wish to remain disciplined, but also want to embrace the opportunities before us and continue to manage risk in alignment with your goals and plan. That's really important. And with the world looking different 10 years from now, we do look forward to helping you get there. Okay, so the bottom line here, I love this line: uncertainty isn't a signal to retreat, it's a cue to prepare. Full disclosure, we like to prepare prior to the event, but still, it's a great tagline. And disciplined investors who remain diversified, tax aware, and forward looking are best positioned to navigate what's next. So, our next steps here: digest this, especially or as well as our monthly updates. If you do wish to schedule some time with us to discuss any aspect of your portfolio or plan, let us know. Share this with someone who may be navigating complexity. We love complexity because we also like to then simplify that complexity. And then reflect. Are you investing in alignment not just with your financial plan, but does it reflect you personally? So with that, and before we open it up for questions, first names only, Erica Sullivan, would you be so kind to provide us with a quick team update here before we wrap up?
I'd be happy to. I think I get the fun part in all of this. Hello. So, as many of you know, continuity has always been a cornerstone of our practice. Thank you, Tom. It's what has helped us deliver a consistent, seamless experience and has really allowed us to uphold the high standards that we think you've come to expect from our team. So, with Tom's upcoming transition, you may or may not know that we've been actually actively looking to add to our team so we can continue to deliver that same level of service across the practice. And after a thoughtful months-long search, we're very excited to let you know that we have found somebody who we think is a great fit, and she's slated to join us on September 2nd. So good news, we're very happy. She comes with solid industry experience and is genuinely excited to play a role in supporting you and our growing client base in the years ahead. More to come on this front. We'll be sharing further details about her and her role soon, and we're very much looking forward to introducing you all in the coming months. So that is the very short practice update for now. More to come, but with that, I will turn it back to you, Tom and Casey.
Well, nicely done, Eric. I'm impressed, but not surprised. You've always been that kind of magic set of hands in the background, making everything come together. And I think everybody appreciates having you on screen today so they can see what you're really made of.
Well, thank you.
Well, and for compliance reasons, I'm going to flip through the next few pages so that we can get this approved and send it out to everybody. So bear with us here, and then we will open this up for Q&A before we conclude. A lot of disclosures from all those pages of charts. All right, let's bring this back and let's open it up for Q&A. All right, so if anybody has any questions, I believe you should be able to raise your hand. Let's see here, Q&A, here we go. All right, one came into the queue already. You can either type one or you can, I believe, raise your hand. So when we think about valuations, historical and present, how do you layer in thinking that captures the company's profitability expectations and the ability to deliver has increased significantly with technology? For 30 years, the gold standard was to achieve rule of 30, then rule of 40, and now it's rule of 55 plus. Wouldn't that support a higher PE ratio on market average? Great question. Coming back to the trend line too, yes, it would support. We didn't incorporate this slide. We used this one instead, but in meetings, we have actually started to use a different slide, which does reflect how the trend line itself, this was actually something we discussed prior to our conversation today. The trend line itself is in fact coming up because as expensive valuations remain more of the norm and you do have higher profitability, that trend line is in fact tilting upwards. and therefore it may not be as expensive as it were to show if that line was static or if valuations remain static compared to the 30. So believe it or not, this trend line is actually adjusting on a monthly basis to account for some of these higher valuations being the new norm to some extent. And there's very much some truth to that. Tom,
One of
anything
the
you
things
want
we
to chime
talked,
in?
Casey mentioned, we talked about this prior. We talk about the mean actually changing, which it will happen, as he just referenced. It will happen over time, but means are not the same as averages, and it takes quite a bit of time to have a mean change significantly. They're less influenced by the extremes.
Yeah, and it may be too. I mean, when I think about, let me bring back the pointer. Mean reversion may not be one of those dramatic, one of these. It could be more of these because of that mean evolving over time. So, great question. Very true. Another question just came in. What will happen to the market if Trump fires Jerome Powell? Tom, you want to take this one?
I think, well, first of all, it would be historic if that were the case. It is really unclear, quite frankly, if he could be fired by the president. But I don't think we're going to go down that path. I actually had some time with a friend of mine last week or 2 weeks ago, who is Mr. Powell's neighbor, ironically. And Mr. Powell is not the least bit concerned about being terminated, fired, or whatever. He's got his head down. He's focusing on his job. And apparently he's quite a musician. So I'm not sure I'd worry about that. I think it makes for good headlines, but I don't think it's going to happen. Now, will he be reappointed? Maybe not. And what lies ahead is anybody's guess.
And we had someone chime in on that might also create a buying opportunity. We always appreciate that mentality. All right. Anyone else have any questions? I think the chat, you can again type it through the Q&A portal of the webinar itself. All right, I think we might be all set here. So just bringing it back for compliance reasons. And there we go. So with that, on behalf of, again, everyone here at Clove Hitch, we do want to thank you very much for making time within your busy summer schedules. And we truly cherish our support of you, our responsibility to you, your family, and loved ones. We are grateful for your trust, and we welcome any questions that may come up as a result of the conversation today or anything that you may be thinking about or need help navigating. As Erica said, more to come on the newest team member. We wish you all a wonderful summer or rest of summer, and thank you again for today.